It's great to see so many of our investors as well as new faces online today. I am Russell Pillemer, CEO of Pengana Capital Group Limited, and today I have with me three representatives of GCM Grosvenor, the investment manager of the Pengana Private Equity Trust PE1. Fred Pollock, Managing Director and Lead Portfolio Manager for PE1. Corey Lopretti, Executive Director, involved in the day-to-day management of PE1, and Lee Brashear, Managing Director and Co-Head of the Private Equity Co-Investment Practice. Despite private equity being an asset class that has historically outperformed listed equity, it has historically also been underrepresented in retail investor portfolios. This changed in 2019 when we launched PE1, giving retail investors exposure to an institutionally managed and diversified private equity portfolio with daily liquidity via a single ASX trade. The recent months have seen strong performance in our underlying private equity portfolio, which has over 350 investments, with a number of our long-held underlying companies becoming household names. Rivian, an adventure electric vehicle manufacturer, just had the sixth biggest IPO on a US exchange and is now valued at over $100 billion. Nubank, the largest Latin American fintech, is preparing to IPO with a target valuation of over $50 billion. Stripe, a payment processing company, is now valued at $95 billion, almost tripling its early 2020 valuation. And SpaceX raised money early in this year at a $76 billion valuation, representing a 60% valuation increase. On today's call, Fred and Corey will begin with an update on the PE1 portfolio. Lee will then follow with a deeper dive into GCM's approach to co-investments, which will cover those currently in PE1 as well as future opportunities. The formal presentation will take about 25 minutes through to 9:30, after which we will have a short Q&A session. Please submit your questions via your screens, and we will endeavour to answer them. We will do our best to answer all the questions, but considering the large number of people on the call, this is highly unlikely. In the event that any questions are unanswered, we will respond directly to participants after the call. Fred, over to you.
Much, Russ. So as Russ mentioned, my name is Fred Pollock. I serve as the Chief Investment Officer of GCM Grosvenor and also serve as the Portfolio Manager for the Pengana Trust. So the first thing I'll talk about, if we could turn to slide 6. I'm only going to take a couple of minutes and set the stage, but then I'll be here obviously for questions as people have them towards the end. And then Corey's going to go through some details on the portfolio, and Lee's going to take the bulk of the time to talk about our co-investment practice in depth. On slide 6, Grosvenor is basically as big and strong as it's ever been as a firm. So we have about $67 billion US of assets under management today. That's up from about $50 billion of assets under management 3 years ago. The number of investment professionals, number of employees, number of clients, and capital that we're deploying in our strategies is all at kind of record highs, in line with the market, but also growth for a positive asset manager. And then the performance that you would see in each of the relevant verticals that we'll talk about for the trust has been exceptional across the board. And that's not an overnight success story. I think if we go through, you'll understand these platforms have been built over a 20-year period, and the current environment is actually quite good for alternatives, and we're benefiting from the construction of those strategies. If we go to slide 7, just as a reminder of what's in the portfolio. So as Russ mentioned, the point of the trust was to deliver institutional quality private equity solution to the market, fractionate that, allow people to be able to trade securities, provide an income component with a significant dividend, and then be able to provide real capital growth through the compounding of the residual capital over time invested in these types of assets. We did that through a lot of different strategies that we executed at Grosvenor, and we tried to bring the best of each of the things that we do. The bulk of the assets in the portfolio are opportunistic investments, co-investments, secondaries. There's a sliver of primary funds, which are kind of existing primary allocations to funds that we've made, as well as a couple of new ones we intend to make, and then filled out with cash and private credit management across the platform. The good news, and Corey will go through this in great detail, is we're very far along in the process of investing the capital, procuring assets. We actually have, we were talking about it earlier today, probably down to about 15% cash in the portfolio, which means that we're very well on pace to stay invested in companies. If you did a look through to the underlying companies, I think we're bordering on 300 or 400 companies at this point in terms of our expectations for either the existing allocations or what those primary funds and secondaries funds will do over time. And so the other component that we talked about when we have spent time with all of the investors in the Pengana Trust, the diversification, the idea of delivering kind of 400 or 500 companies worth of diversification in the private markets. I think we're well on path to be able to do that as well. And the early performance in the vehicle has been exceptional during a period where we were obviously ramping up exposure. So if you thought of capital in the ground, and Corey will spend time talking about this, the return on equity, over this period has been very, very good, and it's been able to lead to an overall economic return on the trust that I think has been above people's expectations during that ramping phase. And on a go-forward basis, I think we're starting to enter the steady state where we can deliver kind of a mid-teens type return as well as deliver the yield that we talked about. If you go on to the next slide, slide 8, the other reminder, we tried to diversify over time. So one of the important things that in private markets we like to do is not have all the capital enter the market at the same period of time for a lot of different reasons. Russ mentioned a couple of different investments that we've made in the pre-IPO space over the last 2 or 3 years that we're now benefiting from significantly as they go public. We would like to make sure that people are diversified over time because those environments can change, right? IPO markets can open and close. Companies can go public in different sectors, and you can have different areas of opportunity. We've tried to provide diversification by committing to these different types of strategies. The primary funds that we have invested in are now drawing down the capital and will over the next couple of years. The secondaries funds we've invested in have already have a lot of assets in the ground and we're benefiting from current market conditions. And then, the opportunistic investments and the co-investments provided real immediacy. And so in a lot of the early return that you'll see in the Pengana Trust have come from some of the opportunistic investments, and Russ mentioned a few, and then also our co-investment practice, which Lee's going to spend a lot of time talking about through our co-investment vertical. With that, maybe I'll turn over to slide 9. I'll turn it over to Corey to go through some details about the portfolio, and then I'll obviously be here to answer questions as we get to the end. Corey?
And good morning, folks. Thanks for joining us today. Slide 9 really provides a high-level overview of PE1's current portfolio allocations. As you can see, the portfolio already has exposure to over 60 funds and 350 companies with vintage years dating back to 2004, well on our way to the broad diversification we are seeking for the long-term portfolio. As you look at the portfolio mix, you can see that our opportunistic sleeve is a bit larger than the other sleeves, which is really due to that very strong performance to date that the investments that sleeve have had. The other sleeves are tracking along really nicely. With our primary sleeve, I'd say slightly behind, really due to the fact that the managers we committed to remain cautious about deploying capital through the early parts of the pandemic. That said, deal flow has been really, really strong this year, and they've really started to ramp up their activity and really build out their portfolios. We always knew as we built the actual portfolio that the mix would vary over time and will continue to do so. So we feel pretty good about where things stand today. Turning to slide 10 and the actual portfolios. So it's now been 2.5 years since we launched PE1, and it's already well diversified. We committed $407 million to a mix of private equity investments. We've committed more than 100% of the capital we raised from investors, and we are already beginning to see realization activity within the portfolio and expect that to accelerate in 2022 within our co-investment, opportunistic, and secondary sleeves. We are also just short of our long-term portfolio goal of being 70% private equity, ahead of the 3 to 4 years we believed it would take to get to that level when we launched PE1. Within the PE primary sleeve, we've made $78 million of commitments to 13 primary private equity funds, includes 11 difficult to access middle market buyout and growth equity funds, and 2 special situation funds. We have exposure to funds from 4 different vintage years across buyout, growth, and special situations. As a quick reminder, within our PE primaries allocation more broadly, we have generally targeted disciplined sector specialists who we think have the unique sourcing and operational capabilities to drive values, and probably most importantly, have demonstrated those capabilities over multiple market cycles, as those types of managers have proven to be the most successful no matter where we are in the market cycle. The middle market buyout managers that PE1 has invested with, they're all historic upper quartile performers. And in nearly all cases, we've been investing with those managers for many years and in many of their funds. For example, Veritas 7 is one of 7 Veritas funds we have invested with at Grosvenor. We've committed more than $1 billion to those funds on behalf of our clients. They are one of our highest conviction managers, and we have also co-invested significant capital alongside of them over the years. And in fact, about 10% of GCF2, the vehicle we make co-investments through, is actually comprised of 3 Veritas co-investments. In terms of underlying investment exposures, the primary fund that is called the most substantial capital to date is Carlyle Credit Opportunities Fund, which has now committed over 100% of its investor commitments to 35 deals. They're already seeing meaningful realization activity. They've returned about 40% of investor capital to date, and they also have had a pretty healthy cash yield of about 8% since inception. And then after a cautious start, Veritas 7, they've rapidly ramped up their investment activity. They've now deployed nearly 60% of their commitments to 3 platform investments since last October. The first deal in that fund was a company called Gainwell Technologies, which is a technology solution provider that is vital to the operations of health programs throughout the United States. That investment has already seen revenue and EBITDA outperforming both budget and prior year numbers, and the company has been marked up to a 2.5x gross multiple as of 6/30. PE1 actually has exposure to that both through the Veritas fund as well as through GCF and MAC2. And then finally, PE1's most recent primary fund commitment was to a fund called Furious Capital Partners 5. They're a middle market buyout fund that makes control-oriented investments across a variety of sectors, including financial services, business services, healthcare services. They really focus on smaller companies, looking for companies with enterprise values between 50 and 250 million. All 4 of their prior funds are upper quartile for both an IRR and a multiple perspective. And as Fred mentioned, we will continue to add new primary funds over the years. We're actually completing diligence on a new primary fund now with one of our highest conviction sponsors that we'd expect folks to see in the portfolio late this year or early next. Turning to slide 11 in our co-investment allocation, GCF2, as a reminder, targets co-investments alongside high-quality middle market buyout managers in companies that have established revenue models, preferably in defensive sectors, things like healthcare and consumer staples. PE1 has a $52 million commitment to GCF2. 85% of that has been funded to date. GCF2 has committed $700 million to 23 companies, and that portfolio is very well diversified by industry, geography, vintage year, and sponsor, thereby providing really good downside risk mitigation. Portfolio recently had its first realization when Veritas sold Alliance Science and Technology to Huntington Ingalls. The investment generated a 2.5x multiple, a 34% IRR on GCF's $23 million investment. In addition to that exit, the portfolio has been generating meaningful liquidity, with Relam, a maintenance of way and railroad equipment leasing company, already returning nearly 80% of invested capital, and both Spiceworld and Inifis returning around 50% of costs through a mix of dividends and dividend recaps. We also learned a couple weeks ago that PA Incorporated, which is a U.S. defense and government services contractor, they're being acquired by another government services firm later this year. And we have some good visibility on another exit that is likely to begin in early 2022 as part of a staged sale process. And think there could be at least one more at full exit in 2022. Overall returns for the portfolio have been quite strong thus far. Net returns to investors north of 30% and a multiple up around 1.5x. And that's as of June 30th. We actually expect that to increase a bit once our Q3 marks are finalized. Turning to the next slide and our secondary activity in slide 12. So for the secondaries portion, we seek to leverage the strong relationships we have as a primary investor in over 840 private equity funds to get really good sourcing and market intelligence. We've seen a significant increase in activity with our secondaries allocation after a very slow 2020 that was really driven by the significant decline in LP sales last year. Since the end of 2020, PE1 has committed $95 million to 5 secondary transactions. One was a $45 million commitment to our secondaries fund, GSF3, which is designed to provide some more mature secondary opportunities, targeting transactions when more than 50% of the acquired capital commitment is drawn by the underlying fund manager at the time of closing. The fund has already closed on 4 transactions, representing around 10% of investor commitments, and has several other investments that it's completing diligence on. The second transaction, we refer to as Project Rambler, involved a nearly $40 million commitment to 4 fund-to-funds vehicles. transaction involved the acquisition of a highly diversified portfolio of LP interests consisting of underlying exposure to 36 funds from 2004 to 2012 and approximately 100 underlying portfolio companies. We were really well positioned for that opportunity as they acquired those funds because we had significant overlap with the underlying portfolio, more than 2/3 of which were either first or second quartile on an IRR basis. Given our knowledge of the funds, we were able to individually model over 90% of the NAV. And that transaction has an estimated discount at close of over 30% due to post-record date write-ups within the portfolio. We're also already seeing strong distribution activity and don't expect a significant amount of our unfunded commitment to those vehicles to be drawn. And then last, but certainly not least, I will turn to our opportunistic allocation, which is being executed through now $180 million in commitments to MAC 2 and MAC 3. The MAC funds have the flexibility to invest across our entire alternatives platform, opportunistically choosing the best deals from wherever sourcing channel they come from. MAC 2 is fully invested and has shown strong performance to date, generating a 1.8x multiple and a 40% plus IRR. Back in March of last year, the team really positioned the portfolio towards potential COVID beneficiaries, and a number of the companies have seen strong performance as a result of the secular tailwinds that were accelerated by COVID. Russ mentioned Rivian as one of them, and he mentioned Stripe. And I'd be remiss, although we talk about it on a lot of these calls, not mentioning Instacart, the leading online grocery delivery service. It is also the largest private equity position in the PE1 portfolio. Instacart significantly benefited from the stay-at-home restrictions put in place due to the pandemic. They have had several financing rounds since our initial investment, and it's currently marked at $35 billion. We believe it could go public next year at a significant premium to its current mark. All in all, the opportunistic sleeve of the portfolio has performed extremely well, and it's really been the primary driver of performance in the PE1 portfolio to date. And then quickly on slide 14, so all of this activity within the portfolio has led to these very strong cumulative returns since inception. Overall, the NAV is up about 30% since inception, with annualized returns of around 10% as of the 31st of October. One last thing I'll note here is that because private equity returns are reported on a quarter lag, you can see performance bottoming out as a result of COVID in June of 2020 rather than March. It has been a pretty steady climb since then in local currency returns, with strong Aussie dollars muting returns a bit earlier this year. We think this performance is made even more impressive by the fact that we're still ramping in the portfolio over the last year and a half, which means that the actual PE returns are well in excess of the returns reflected here. So let me stop there and turn it over to my colleague, Lee Brashear, to talk a bit more about our co-investment practice.
And good morning, everyone. So I'll talk a little bit about our platform and give you an idea of some of the deals that we're doing on the co-investment fund. So what we do with our co-investment platform is really leverage the entire platform to source deals alongside the best managers in the market and create a portfolio of opportunity that has diversification across a lot of different metrics, which we'll go through. We've been co-investing for the last 18 years, committing over $5 billion of capital to close to 200 different investments alongside over 100 different partners. So we have experience over different market cycles and across all sectors of the economy, and sponsors that have a lot of different strategies from which they create value and thus drive returns. We source predominantly from investors where we have made a primary fund commitment. So close to $12 billion has gone to these funds as a primary commitment, and then we leverage those relationships to help them co-invest in individual opportunities when they have the need for those. It's a broad network, so it's over 400 sponsors that we're sourcing deals from, and that generates almost 370 deals per year that we get to choose from. We're an active co-investor, so we often will be the only additional capital source or the largest alongside that private equity sponsor. And we have a highly selective process where we're only committing to about 5% of the deals that we see. So we're really looking for the best of the best deals in any given year. Next slide, please. So how do we get these opportunities? We build relationships with some of the best investors in private equity really early on in their fund life cycle. So some of the names you see on the page, like a TSG or a Veritas, we believe are some of the top investors in their respective industries. Many of these focus on a single sector. TSG focuses only on consumer companies, Veritas on government and defense predominantly. And we think that lines up to create an interesting mix to be able to add value and really deliver return creation to the underlying portfolio companies that they invest in. We get invested with these firms early, and then we scale our positions with them over time and help them do things like co-invest and provide secondary capital as they grow their own franchises, and then typically become hard to access. So we're providing access through co-investments to some of the best middle market firms in the marketplace. Additionally, we are investing in new relationships every single year. So we're trying to find the next generation of best managers and adding those to our sourcing funnel that also generates and expands the overall deal flow that we get to look at each year. Next slide. So a couple of areas that we've been investing in over the last few years. Number one, technology has been impacting every single sector of the economy. We've played this several different ways. One portfolio company in the GCF2 portfolio is our IT go-to-market strategy for Microsoft and SAP software in the Germany, Austria, Switzerland region of Europe. So this platform really is the frontward-facing go-to-market strategy for those software platforms, selling mostly to small and medium-sized customer bases. And there was a lot of opportunity there to just continue expanding the market share, the country reach, and just take advantage of the trends in the marketplace to adopting more IT services with a really compelling revenue model that lend itself to a lot of recurring revenue stream. Another trend that we've been investing into in more stable core end markets is the food space. So participated in a carve out from Campbell's Soup Company of Bolthouse Farms, which is the largest fresh carrot producer in the marketplace. And this had a really compelling theme to it of bringing back the old management team that actually sold it to Campbell's, and also being able to push a lot of different operational initiatives and just strategic reduction of the overall footprint to help improve the profitability of the business. And then lastly, aging demographics and healthcare costs have been a continuing issue in developed markets. Here in the US, we backed a business called Cotivity that is a large data and analytics solution provider serving mostly the payers and trying to just drive costs lower through more efficient management of the billing cycles and bills totally. Next slide. One of the things that we can deliver through the co-investment fund is portfolio construction that we think is diversified by different ways to contribute to the overall return creation. So when we are putting this portfolio together, we're paying particular attention to how each of the underlying sponsor and deal actually create value, create growth and profitability, and how that translates into the overall returns. So we look at things like cost structure optimization, where the sponsor has a plan to go in and reduce cost or make things more efficient to be able to increase the overall operating margins. We include companies where the main thesis is really to drive revenue growth and sponsors who know how to just accelerate that through new products, new channels, new ways of selling. Additionally, we invest in many industries that are highly fragmented and offer the opportunity to back a platform and then go out and acquire add-ons to that platform, getting multiple accretion and overall enterprise value increase just by consolidating an industry. And then lastly, we have an opportunistic deep value approach for some investments where a M&A process may have fallen apart, where there are particular stresses on a seller that cause us to get an interesting purchase price for that asset. So we do also pursue those types of opportunities. And as you can see, we've approved a balanced approach to the value creation strategy employed, so that we're not really reliant on any one kind of macro driver, but can really rely on the different ways that these sponsors can create value and thus generate return for the overall portfolio. A couple of case studies from the portfolio are outlined here. The first one is BDP International. A lot of the companies that we pursue alongside these middle market sponsors, many of these are former family-owned companies. BDP is a great example of this. This is an asset-light logistics provider alongside a sponsor that it solely operates in the logistics sector. And this was a multi-generation family-owned company where this would be the first institutional capital. And that offered a lot of ways to create value, everything from augmenting the management team to increasing the IT footprint to reducing some of the actual office exposure that they had, and then just helping them push growth initiatives in reinvesting capital versus sending capital as dividends back to the family. So a lot of low-hanging fruit and a lot of just strategic work that can be done there. That business, we made that investment in 2018 in the first year of the fund, and the business has now significantly increased its EBITDA and profitability, and has been marked up significantly from cost. I mentioned Cotiviti, so won't go into that one again, but lastly, we have Innophos, which was formerly a public company, one that was really too small to be public, didn't get the right analyst coverage, was just under $1 billion of market cap. So had provided an interesting opportunity from just an entry valuation standpoint, and one that is involved in the phosphate rocks production that goes into all types of products, everything from consumer products like carbonated beverages to industrial products like paints, cleaners. So had a broad range of end markets that they were selling into. And we partnered with a sponsor here who really was an expert in complex situations, who had a plan to figure out how to take the company and increase profitability really by looking at a lot of the operating metrics that the business had, some plant consolidations, discontinuing some product lines, restructuring some of the supply chain. So a lot of blocking and tackling work that's so far resulted in significant appreciation in the EBITDA there in almost a 2-year holding period. So as you can see, it's a pretty interesting and broad range from family-owned to publicly traded companies that we're pursuing, but all have a common theme of actionable thesis with a sponsor who has prior experience in executing those initiatives that we can bet on to help build the EBITDA of the business and drive returns for the portfolio. Next slide, please. So what's going on in the markets today? I think we're experiencing probably one of the most active couple of quarters of deal activity overall. The pandemic kind of slowed some of the exit plans that sponsors had last year. And a lot of that has been sped up this year to make up for some lost time. And then various tax changes and other potential things are causing some owners, particularly on the family-owned company side, to want to get to market and sell. So right now, there's probably more opportunity than ever. When we look at what our platform generates, we've continued to see just increasing number of deal flow when we compare it to 2019 and 2020. So our ability to pick and choose has continued to go up. And then financing for all these transactions continues to be available and very borrower friendly. So our job is to really pick and choose based on the trends in the particular sectors, as well as the sponsor partners who are showing us these opportunities. So lastly, I would just wrap up and say, next slide, please. Lastly, just wrap up and say for the fund, this product allows access to a very cost-efficient access to private equity, exposure to very high quality, hard to access middle market sponsors, and then allows a comprehensive portfolio construction that's diversified across a bunch of different metrics like investment year, sponsor, number of companies, industry, and then value creation methodology that we believe result in a pretty compelling risk return profile for the fund.
Thanks, Lee. That was a really interesting presentation. We'll now go on to the Q&A. And as I said before, I apologize if I don't have a chance to get to everyone's questions. Let's kick off with a question. Fred, this is probably for you. At which stage does private equity become investable, and do you fund startups?
Good question. So traditionally for us, we only invest in mature firms. And by mature, I mean firms that have a proven revenue model and have proven unit economics. It doesn't mean necessarily that they're profitable, right? So they could be in a phase of their growth where they're actually consuming cash to facilitate that. So, one of the examples you gave earlier, Russ, was Rivian. That would be in that phase, right? So they have a proven unit economics, but they don't have proven revenue, and they're still funding that growth with negative cash flow. So we do that. So, but the percentage of the portfolio that would be invested in those types of companies is actually quite limited. So we try and keep that down to sort of 10 or 20% of the portfolio. Venture would be going back much earlier than that. So typically with venture, you're looking for companies that maybe aren't that progressed, aren't doing those types of mature capital raisings. And so, the probably the simplest way of thinking about this, people raise capital in what are called series. And so series A or seed type investment, most venture firms would do. Even series B, which is kind of typically a year, 2, 3 years after the first round of financing, we won't really participate in. We're almost always investing in a series C or D round of investment before an IPO, even in that kind of 10 to 20% of the portfolio. We were engaged in that activity. And then the vast majority of our portfolio is in tried and true cash flowing enterprises across every sector of the economy, where we think that there's good pricing power, a good business model, and a competitive competitive advantage associated with what they're doing. So we sometimes talk about these companies because it's active, and there's a lot of media and press around some of these things going public, et cetera. But the vast majority of what we're doing are in these sort of more boring or sleepy companies where we're just generating good cash flows, and the portfolio is benefiting from them.
Great, thanks. Next question. When you're investing in a company, to what extent are you backing the management team versus the company itself versus the idea or the plan?
Sure. Maybe I'll let Lee, if you wouldn't mind taking that one. I think you maybe could talk about it from a private equity co-investment perspective.
Yeah, sure. So the answer is we do look at every aspect of the transaction. So we are evaluating the end market. We're evaluating the actual business. What do the financials look like? How stable is the business? Where are they winning? How are they different? What's the competitive landscape? But really equally important is, what is this sponsor going to do with this business? And that is what we're trying to underwrite, is their thesis, how that makes sense, and how that leads to a compelling return profile. We think we have the ability to do that because we're usually an investor in their fund, and we can see all of their history in implementing the same type of value creation initiatives in prior deals. And we have the results of those investments. So we can do a deep analysis, even down to the person at the private equity firm, and understand how good they are at doing the same thing they're proposing in this latest investment. So it's a comprehensive underwriting, and it is probably equally weighted between attractiveness of the company, the market, and then the owner, because the owner, once they have closed on the deal, they can make changes, make new investments in the business, and just they ultimately will drive the returns for the deal.
Great, thanks. Lee, this one's probably for you as well. Does an investment need to have an exit strategy, or can it be invested in for a long-term hold?
Yeah, so we typically will go into an investment understanding what we think the exit route will be. Oftentimes, there will be multiple potential exit routes for an investment. Many of our companies, being middle market focused, are typically selling up to either a larger sponsor or a strategic. So a company that's either public or a portfolio company of another private equity fund. So when we are doing the underwriting, we have a good idea of what we think is possible. And then it's really based on capital markets, how big the company has gotten once the exit timing comes near. Typically, we're underwriting to a 5-year holding period. Admittedly, a lot of the holding periods have come in a bit, so we're seeing companies sell at 3-4 years today. But generally, that's what we're trying to achieve, is roughly a 3 to 5 year holding period for each investment that we make in the fund.
Thanks. Next question. There's been a lot of discussion in the Australian press about Rivian. Maybe Fred or probably Fred. Can you maybe just comment on Rivian, how we got invested, and how what we've done since it's gone public, and how much of the stock do we still hold versus, and how long do we still need to hold the stock for?
Yeah, it's all good questions. So, and Rivian's, it would fall into this high profile but small percentage of our overall portfolio. So probably the first thing to say, one of the resounding principles behind the way the PE trust is managed and built, no one company is going to drive outcomes either positive or negative. But I think these examples are useful for bringing to life sort of how we're generating, when you add them up and you add up 100 of them or 200 of them, how we're generating kind of profits. So in the case of Rivian, we invested 3 different ways. The first, bordering on kind of a year and a half ago now, we invested in the common equity of Rivian, or preferred equity, it should have been, because it had a liquidation preference, at about an $18 billion valuation, is a co-investment partner with Coatue, which is a leading pre-IPO sponsor. We then provided a convertible instrument, so a debt security, over the summer, which was a pre-IPO convertible instrument, which had very good downside protection, and then would convert in the IPO at a substantial discount to the IPO price itself. And then we had rights associated with those securities to participate in the IPO. Each of them had different obligations associated with them. So in the case of the common equity, preferred equity we bought early, there's a 6-month lockup. In the case of the convert, there's a 3-month lockup. And in the case of the IPO shares that we were allocated for purchase, there was no lockup at all. And so in the aggregate, we invested about $225 million as a firm in Rivian. We today have about $300 million of P&L. So we have a position between the cash realized and the existing investments, about a $525 million position on a $225 million investment, which is, the weighted average life is kind of 3 or 4 months. So it's been a great investment, at least on a mark-to-market basis. About half of that P&L is realized. So all of the shares that were part of the IPO process, we're able to purchase in the IPO and then liquidate into the market at a price of substantially above what we purchased in the IPO itself. That obviously involved risk, and so that wasn't a riskless transaction, but we were pleased with how it worked out during the first week of trading.
Thanks, Fred. And if you can comment, and I think Corey, maybe this is for you, what percentage of the portfolio pre the IPO was invested in Rivian? Maybe just an estimate.
Yeah, I mean, from a look-through exposure perspective, it was 1 to 2% of the portfolio pre-IPO. So pretty small. In every position, even I think our 10 largest make up about 30% of the portfolio. Instacart is the largest at about 8 to 9%, with most of the positions coming in much smaller than that, which is designed intentionally as we wanted to have that broad company diversification through the portfolio.
And just on Instacart, which I think everybody understands, large position in the fund and has been extraordinarily successful for PE1. Is there any update on when that might IPO?
2022 is the current expectation. So first half of 2022 would probably be a decent guide, but we couldn't really say more than that at this point. We obviously, it's been in process since Q3 of this year, but it takes typically 6 to 9 months to get a company through that process.
Thanks. Fred, maybe this is for you. Does PE1 have any exposure to blockchain, or do you intend to have any exposure to blockchain?
Well, it's an interesting question. The answer is we don't own any, how should I put it, digital currency. So there's no Bitcoin, Ethereum, none of those investments are made in the trust, obviously, because we buy companies, whether they're pre-cash flow or cash flowing companies, and that's how we invest in pretty traditional. But many of the companies that we invest in are participants in the growth of and usage of ledger technology, which essentially what blockchain is just a secure ledger technology. Most of the companies actually would be using that in one form or another to manage inventory and the supply chain. And then a couple of the companies would actually be investing fairly significant amounts of money around what they view as an opportunity in digital currencies. So Nubank would be one, Stripe, would be another, where Stripe has a very significant part of their business and what they're trying to grow is associated with digital currency and the growth of digital currency. So I think probably the right way for us to participate in that avenue is exactly what's happening, which is we're allowing kind of world-class management teams in the companies we own to, where appropriate, pursue those opportunities adjacent to their business. But we're not speculating directly in the currencies or any part of the chain.
Right, thank you. Next question, I'm combining a couple of questions together. What are there any existential or severe risks that investors should be aware of in the portfolio, obviously in your view at the moment? And are there any reasons why the portfolio might struggle over the next 3 to 5 years?
Yeah, maybe I'll take that. So look, there's always events, but events are not really what's going to damage the portfolio. And so, meaning, what do I mean? I mean natural events that we all worry about as risk managers. So things like global pandemics, which we experienced, in 2020, or earthquakes, significant events that destroy a lot of capital, hurt significant numbers of people, and really damage the portfolio in one way or another. Those tend to be pretty isolated because the portfolio is so diversified, and it tends to help us avoid sort of substantial single name or idiosyncratic risk. So the big risks that are left, one is just the beta. And by beta, I mean exposure to global growth and the global economy. So if there's a significant slowdown or acceleration in global growth, we will suffer, we will benefit from that pretty significantly through most of the investments in the portfolio. It's obviously a long bias portfolio, and we're correlated to those things. I think the other would be rising rates. So far, we've been in an environment where you have inflation. Most of the companies we invest in are actually good companies with moats and good competitive advantages. So they're able to pass through most of those effects largely. And in many cases, they have pricing power and they're able to benefit from that. But you haven't really seen a rise in rates themselves, and particularly long rates, right? The thing that we would be worried about from a financing and cost of capital perspective. I don't think it would cause a significant amount of value degradation in our existing portfolio, but if rates stayed sustainably high for a long period of time, it means people's discount rates will go up, which means the present value of all cash flows goes down. And our portfolio is not immune from that, right? It's an amalgamation of interesting economic exposures that produce future cash flow. So, we would be hurt by that. And then finally, and you might want to touch on Russ, just as currency. So one of the substantial risks associated with the portfolio is most of the assets are US dollar assets. And yeah, and obviously there's the potential for the performance of the Aussie dollar versus the US dollar, although I think historically that's almost been counter trend to risk. But maybe you want to comment on that one, Russ?
Yeah, I'll take that one. So I think as investors will probably be aware, the portfolio is not hedged back into Aussie dollars. So it's a US dollar, predominantly US dollar exposure. Historically, what that's meant is that when in times of stress, so basically if you look at a market crash type scenario, the Aussie almost always reduces in value or derates. And so what you find is in those periods of time, we actually make money from the currency changes. So it actually provides us with what we call a hedge against catastrophic falls in equity markets. So that's a mitigating factor. The flip side of that is that in a world where the Aussie dollar is rising, we do lose value, and you've seen that right from time to time, that the Aussie dollar can go in a bit of a spurt and increase quite rapidly. And so during periods like that, we will have losses or could have losses in the portfolio. We like that trade-off because what we usually find is in a world where everything's going well and there's synchronized global growth, which is very good for our underlying portfolios, it's usually that type of world in which the Aussie dollar is doing well. Whereas in a world where things are not going too well, the Aussie dollar is depressed. So we like that hedge in the portfolio, and we think that's actually a benefit of having the portfolio unhedged. I'm sorry. I think I'm going to end the session there. We've gone a little bit over time. We will most certainly get back to everybody who's not had a chance to have their questions heard. And thank you everybody for attending today. We appreciate your time, and we hope to see you in person in the not too distant future.